Good morning, ladies and gentlemen. Welcome to IGE Forum. Today, we are most fortunate to have an outstanding guest speaker, Dr. Henny Sender, who is the world's most respected journalist, as well as an expert in the area of international finance and investment. I'm very confident that her exceptional insights will help us understand recent trends and emerging issues related to the global finance and economy. Briefly introducing Dr. Sender. Dr. Sender has recently joined the world's largest asset management firm, BlackRock, as a managing director after a distinguished career as chief correspondent for international finance at the Financial Times, FT, for 13 years. Prior to joining FT in 2007, she served as a senior special writer for the Wall Street Journal for 10 years, where she received a prestigious Loeb Award there. Henny's exceptional career also covers her active role at the Far Eastern Economic Review and the Institutional Investor. She holds graduate degrees from the Columbia University. On a personal level, I'm very happy to say that Henny has been a very special friend of mine for years, as well as a mutually trusted partner for our professional activities today. Today's format is a conversation, or so-called fireside chat between Henny and myself. Actually, a fireside chat without fire today. Without further ado, let's welcome Dr. Henny Sender, who is joining us live from Hong Kong this morning. Henny, are you there?
Thank you so much. It's a pleasure to be with you all, even virtually. And I wish you all a very happy new year, year of the ox, a cautious creature and a patient creature. And I think we will need patience. No fire, but if we have light, it will come from our wonderful moderator. Thank you.
Okay, thank you very much. First of all, I would like to congratulate you on your excellent appointment at BlackRock. I'm pretty sure it's a huge addition to BlackRock, a great company already, but I think will play even greater role in the international finance and investment area with your support there.
I think what it says is that BlackRock cares more and more about Asia and realizes just how important Asia is in the world of international finance.
Right. You had an extensive experience in Asia. Of course, your doctoral thesis was about India, and you had a long career experience in China and also Japan. You were stationed there for quite some time, and you know Korea well. So you are most suited to help BlackRock on the issues relating to Asia, which is gaining more importance in this post-COVID era as well. Now, speaking of Asia, since you have a very exceptional insight and extensive network in China, I may start with a big picture relating to U.S.-China relations, because that's going to be an important factor for the global economic outlook and also financial prospect as well. So the first perhaps point that we may like to talk about is your view about the future development of G2 relations. The recent indications seem to suggest that U.S.-China tension is not going to be away anytime soon, if not worsening. What is your view on this? And under Biden administration, how do you see the evolution, the development of this G2 relationship?
You know, I think it will be more predictable than it was under former President Trump. You know, when people would ask me, either in my former life as a journalist or in my current life at BlackRock, you know, what Mr. Trump would do next, you know, even he didn't seem to know what he would do next. So there will be more predictability, which I think is a good thing. But it does seem that at least competition between the G2 members will not go away anytime soon. I think there will be more predictability. I think the emphasis will switch. There will be more emphasis on human rights, on issues like Xinjiang. I hope that there will be more predictability in trade and finance. From my point of view, you know, one of the things that I have always done is sort of follow the money. And to me these days, even before COVID, some of the most interesting flows were going from venture capitalists to biotech. And this is one area, health, where we would gain so much if there was more cooperation. Because if you look at China, its competitive advantage is applying machine learning to a huge database of 1.3 billion people. And as long as that database is put on an anonymous basis, if you combine that strength of China with a historical sense, you know, of competitive advantage in basic research, in hospitals and universities, we could gain so much, not only in dealing with pandemics, but early detection of cancer, all these kinds of things. And, you know, I think beneath the surface, universities are trying to cooperate. Hospitals like Sloan Kettering in the US are trying to find JVs. So we should, I hope, you know, emphasize all the things that could be gained by having more cooperation, you know, and, you know, Korea, like China, faces issues of aging demographics. You know, one lesson of COVID is we're all in the world together. So, you know, if we all work together on challenges of aging demographics, on healthcare, on the environment, how much more quickly we could make progress in solving these things.
Okay, thank you for your perspective on this. Indeed, you know, this change from unpredictability to predictability is a huge advancement. Even though the tension will be there, as you said, for the foreseeable future, and competition may rise, and also U.S. may try to push for greater alliance with democratic governments around the world, which could raise further tension between the two countries. But nevertheless, as you said, there are much scope for collaboration down the road, and good for the entire world and both countries and neighboring states to expand areas where we can cooperate. That's very important point. Now, speaking of China, and especially the money-related issues that you are good at, overnight, we had a very flashing news about Tesla's 1.5 billion investment in Bitcoin cryptocurrency. Now, it's not. I think the issue is not just confined to a particular company like Tesla, but since we were talking about China, as I understand it, PBOC, Chinese Central Bank, has been contemplating to issue digital currency for some time. Since you know this better than anybody else, could you tell us about what's behind this and what their purpose may be, and what sort of message do we get from the development at the central bank level, national authority level?
You know, I think we have to start out by distinguishing between central bank digital currencies and, you know, private sector, you know, cryptocurrencies like Ethereum or Bitcoin. And, you know, they stem from very different impulses. So, you know, to me, and this isn't necessarily the BlackRock view, because, you know, one of the things that I love about BlackRock is there isn't one house view, which is a good thing when you have almost $9 trillion. It's incredibly dangerous to have only one view, and we're still trying to get our collective heads around things like Bitcoin. But it is clear that in a world where most major developed market central banks are doing everything they can to kind of devalue their currencies with these unprecedented amounts of money printing, you know, there is a sense that, you know, a currency may not be as valuable tomorrow as it is today. And that's one of the things that has always been behind the bull markets that come and go in gold. And I think, you know, Bitcoin reflects the unprecedented, you know, money stimulus in the world today. The Chinese central bank has been a leader in central bank digital currencies. And one of the major impulses there is from the fact that, you know, the tech companies, as part of deregulation, have come to dominate digital payments. And Alipay and Tenpay or WeChat Pay account for 96% of all digital payments. And from the Chinese, the People's Bank of China's point of view, that is a kind of systemic risk. And one of the reasons why they're launching this experiment, and it's hard to tell how widespread it is, you know, is to sort of, out of a sense that deregulation has gone too far, you know, we've kind of created, I don't want to say these monsters, but they have become so powerful and so big in areas that the central bank has a feeling that the traditional financial institutions are being totally undermined, and they need to rein back these fintech companies to safeguard financial stability, but also to bring back more power to the state-owned financial system. And of course, all the major banks in China are state-owned.
Okay. Now, speaking of big tech's involvement in the financial services, and that is not the only issue in China, it is in Korea and elsewhere. We face that issue of growing importance of big tech companies in financial services area, vis-a-vis a conventional bank-dominated sector. Now, relating to this, one thing that comes to my mind is the A few months ago, there was a big sort of hiccup, if you like, about Ant Group's IPO deal that was suddenly stopped by the authorities in China. Since you know all those important entrepreneurs, including Jack Ma, involved in this things, what is your sense about what's really happening there? Is this something that the financial authorities would like to have a better handle of systemic risks associated with this mushrooming, this fintech activities by big tech? What is your assessment?
Thank you for that question. It's a very interesting one. You know, for those of us who watch China from fairly close up, it's always interesting to see the gap in understanding. You know, when we look at China, we see, like we see in every other country in the world, vested interests defending their point of view. And yet from far away, China is seen as this monolith. And if you look at Ant very closely, you see this kind of vested interests, you know, and different points of view. So from my point of view, you know, it shouldn't have been surprising and it shouldn't have been alarming. You know, it was better to shut Ant or put Ant back in a cage, if you wish, before the IPO rather than after the IPO. But in fact, it was a long time coming. So in 2018, Ant is raising what is meant to be its last round of funding before it goes public. And if you look at the information it was sharing with potential investors, there was some content saying we are disruptors of the traditional financial system, but they meant it in a positive way. You know, we're all about giving credit to small and medium enterprises, which the banks can't do. So that was, when they talk about disruption, it was in that specific context. But at the same time, they had a page in that document about how regulation would affect them. And at that time, it was all about their Yuebao, which was kind of a money market fund, highly liquid, very short term. And because they weren't a bank, they didn't have the constraints on interest rates. So people who put money on deposit in Yuebao could earn higher rates of interest. And they talked about how the regulators were not happy with it and the growth of Yuebao in the future would be slower than in the past. So that was the first inkling we all had that regulation was coming. Then it was in April, May last year that the People's Bank of China announced their experiment with digital currency. And it was in large part directed at the fact that Alipay and an arm of Tencent were dominating digital payments, and this was a systemic problem. Then in the fall, they changed the regulatory framework about microlending. And in the past, microlending was all about local regulation. Beijing decided, no, we should regulate microlending. And there was a new central bank governor, Gang, who was less sympathetic to fintech and the experiments of his predecessors. And the bank regulator, the CBIRC, was on behalf of the banks arguing with the State Council and the party, saying you have liberated these fintech companies. They're taking advantage of all the loopholes in the regulations. We need a more level playing field. One of the arguments of the fintech companies was we shouldn't have as much capital as banks because we don't take deposits. And the bank regulators' argument in front of Beijing was actually Alibaba and does take deposits. They just don't take them directly because the banks cannot pay out as much on deposits as the fintech companies. They were collecting all this money from their depositors and then putting it in things like Yuebao. So that argument was, you know, in fact, Ant should have more capital requirements. So all this was playing out, came almost to a head. And then Jack Ma gives a speech right after Wang Xishan, a very highly respected senior official, describing banks as pawn shops. He'd just gotten approval something like 12 days before for his listing, and he cannot help himself. He has always been very outspoken. You know, this was a mistake. And one of the interesting differences is outside China and within China in many quarters, Jack Ma is regarded quite fairly as a visionary, as a charismatic visionary and entrepreneur. But to many people in China, he symbolizes decadent wealth. You know, you put on your leather jacket, you dye your hair purple, and you're giving concerts and making movies. You know, you fly to the US to meet President Trump before Xi Jinping has exchanged words with him. You know, there will be a backlash. So all these things are what led up to it. So this is an extreme case, but I do think this will play out everywhere. You know, what is the relationship of fintech companies to the traditional system? What are the systemic risks they pose? Are they too powerful? Do we really know what's going on? And I'll just make one final point because I've talked too long, and that is Tencent has a very different model. WeBank is their financial services arm, and it's a bank. It's digital, but it's still a bank. Therefore, the central bank has much more clarity about its activities. So you might argue that Tencent, with its very low-key group of 5 founders, and the fact that it takes the form of a bank with complete transparency with regulators, is a safer model.
Okay, thank you very much. I think you have shed good light on what's really happening in China, especially China's financial sector. I think with that, we have a much better understanding of what's really happening, and it has good implications for other countries, including Korea, as to most appropriate regulatory regime in rapidly changing environment, including big tax direct engagement and financial services. I think that's very, very helpful to me. Now, before we move on to some stock market issues globally and also US, so is Jack Ma under control? Is he okay now? You have known him for quite a long time, but he re-emerged from several months of sort of disappearance. But I suppose he's okay now.
Yes, you know, he has always had an urge to speak out. And because Xi Jinping was at one point the party secretary of Zhejiang province, And Hangzhou, which is where Ali grew up, of course, is the capital of Zhejiang. He used to actually boast about his relationships with President Xi. He has just been so indiscreet so often. And, Jack knows that he is a visionary, that he cannot execute, but he has brilliant people around him who do that. And, he's just so irrepressible. And, the amazing thing is you would hear him say things like years ago, he was saying at a dinner where I was sitting next to him, soon our gross merchandise value will be equal to the GDP of Germany. And you'd say, that's ridiculous. But then it would be, he's a very interesting person,
Yeah. All right. Okay. That's now, Henny, another issue that has caught our attention lately, although the situation appears to be under control now, subsided a little bit, that has to do with the GameStop, the short sale related saga, if you like. Now, this apparent tension or war, as someone put it, between institutional investors, including hedge funds, and retail traders with individual investors with the help of this SNS platform. Now, what do you make of this thing? What sort of a message or lessons do we get out of this recent frenzy or the saga on the street, on the Wall Street?
We're all trying to make sense of it, and there are so many different interpretations. I think it goes back to what people are kind enough to think of as the global financial crisis, but it was overwhelmingly a US financial crisis that led to the rest of the world. And there was a sense then, which actually led, I think, in many ways to anger, which led to Trump and which led to all kinds of manifestations. But a sense that ordinary people suffered the most from the global financial crisis, and Wall Street, which brought it down on the real economy of the United States, was protected and came out unscarred, and ordinary people bore those scars. So there was a sense of anger and a sense that the system was rigged, and technology enabled the rise of an accessible brokerage firms for retail people, whether it's a Robinhood or, in China, there's a Futu Securities, which is all about making trading accessible to ordinary people. At the same time as these markets are on fire and the Fed, has provided the rocket fuel to liquidity, and it's the richest people and the models of enrichment that only wealthy people are entitled to who have been the beneficiaries. What's ironic about Janet Yellen was that when she ran the Fed, she's a labor economist. She thought if we have easy money, in response to the global financial crisis, we are helping ordinary people. Most of the money, in a zero interest world, corporations weren't hiring people. They were doing financial engineering. They were doing share buybacks. And Fed policies were, in a way, feeding income inequalities. So ordinary people are saying, we want to be the beneficiaries of all this liquidity. We want to have our piece of the inflation in asset prices. And firms like Robinhood were encouraging that. But the ironic thing is they found a vulnerable corner of the financial markets in hedge funds who were taking massive risks because they short stocks. But, you know, hedge funds never see themselves as the heart of the establishment and the status quo. I mean, I personally think that shares can be overvalued as well as undervalued. And who brought down, you know, Enron? Who brought down Lehman Brothers? It was hedge funds taking short positions against shares that were by any measure overvalued, you know, and, you know, in many cases, there were issues of fraud. So by taking the other side, you know, they are accelerating, you know, something which, you know, I think they lend a positive thing to the markets. But, you know, it's a very interesting response because, you know, these retail investors, it was all about, you know, they don't, you know, can they really afford to take these losses that they will sustain? I think it's very sad. And it feeds the anger in the long term. But it is one more expression of the anger of people in the face of a system that they are increasingly believed is rigged against them. But I don't think it's a very functional response, and that's the sad thing.
And one point that you mentioned throughout your explanation just before, which was of great interest, is the impact of fiscal stimulus and monetary expansion. Although it was intended to help economy and in fact, poor people, help those less privileged people find a job and, you know, have a better life. But as one of the recent FT articles also showed that, in fact, the fiscal stimulus, monetary easing, ended up aggravating these social inequalities because that turned out to be helping more privileged with a bunch of financial assets whose values have gone up with this massive liquidity. So it's very ironic that we have this fiscal and monetary policies to help the economy and people, but as it turned out, it's not as helpful as it was intended to be, especially for the poor people. I think that has to be taken into consideration for policymakers in devising right policy response to a crisis. Right? That was a very important point that I wanted to highlight. Now, another flash news overnight that I found interesting, that 30-year U.S. Treasury bond yield hit 2%. That was the highest rate in more than a year. Now, that is there's a sensible reaction or response, reflection on the massive fiscal stimulus package Biden administration is pushing for. That is $1.9 trillion package is likely to move forward. Now, obviously, with that, we most likely have inflationary impact sooner or later. The timing is up to debate. Now, what is your reading on this? This has to do with the prospect for fixed income securities investment, and also, at least in the short term, it has a direct impact on foreign exchange rate market as well, right? As you know, there's a debate going on between Janet Yellen, who thinks this package will help achieve full employment by next year, full employment meaning like something like 3 to 4% unemployment rate by next year without causing much inflationary impact. Whereas someone like Larry Summers very much imagine against this view. What is your sense on this one, on this sort of debate, different view?
The BlackRock Institute view is we will see more inflation, but we will not see yields go up in real terms. Some of my hedge fund friends, their biggest positions are long 30-year Chinese government bonds and short US 30-year treasury bonds. And until recently, they thought the renminbi would continue to strengthen. And so they had no currency hedge on, even though they're basically US dollar investors. Then they began to worry about could there be a short squeeze on US dollars and began to hedge it. I mean, one of the reasons both BlackRock as a firm and me individually, think that the PBOC has become more conventional central bank than many other central banks in the world is they are focused on financial stability. They're trying to delever. They don't want growth to be credit driven. And I think, a lot of smart investors do worry about inflation and the fact that you will see, US budget deficits growing massively and fundamentals of the US economy becoming less fundamentally based. And, the disconnect between the real economy and asset prices continue. I lived in Japan during the bubble years. And, the BOJ people and the central bankers like Shirakawa, who came from the BOJ, said, we have to spend more time thinking about asset price inflation and changing the way we measure inflation and think about inflation, but Ministry of Finance people in Japan, more and more of the asset prices in Japan to me are very artificial because the BOJ is a massive buyer of ETFs. GPIF, the big pension funds, are massive buyers. So people, worry about this massive spending. In the US, there's a big debate even among people who say we're all in favor of 1.9 trillion stimulus, but they have to ask, will it have the multiplier effect that we want? Is it targeted to the right people? If it's just saved or goes into the stock market, in the way that we've seen, GameStop going up and down, is that really the best thing? I mean, I can hardly bear to go back to New York, where I'm from. I picture myself on a subway platform. I have no idea when the next train will come. I'm counting the rats in the tracks. And I think if I was in Seoul, I would know exactly when the next train was coming. There's no rats in the tracks to count. What I would love to see is, a huge infrastructure program, which would have multiplier effects. I mean, my Korean friends, many of them feel like they're going to a very impoverished country when they visit the US.
Yeah, right. That's an issue elsewhere as well in Korea. So we are, trying to further stimulate the economy, especially helping small, medium, and self-employed sectors. In some cases, excuse me, cases helping unemployed people. Now, whether or not it's good to send out all the checks to everybody or target more, vulnerable people. That's a debate. Even though I am on the side of helping more needy people rather than spreading this out all the people in the economy, based on previous studies of experience with dealing with the crisis. But I think this is something to be carefully thought out to minimize the negative side effects of this massive liquidity, and maximize the positive side of stimulus program. Now, perhaps before moving on to the final and very important topic on ESG, we cannot escape this issue with BlackRock, because BlackRock is the world's largest investment management firm, and in fact, largest shareholder of major corporations around the world. Have been
and in Korea,
pioneer, and in Korea as well. Yes, you're right. And especially Larry Fink, chairman and CEO of BlackRock, has been and a leader and pioneer in a way, pushing this forward to have more sustainable growth and sustainable rate of return on investment. This is an absolutely important issue, gained more importance, especially in the aftermath of the pandemic crisis. But before we talk about that, just one thing as a follow-up to stock market story, you did mention disconnect between real economy and financial sector, and often called the decoupling of this. Now, if you would like to add anything about this, it's been a very distinctive element of post-COVID recovery process. There has been a huge gap, sometimes we call it dangerous gap, between real economy that is lagging very badly, but financial market, especially stock prices, were hitting new high. Now, this thing it's not really desirable and also not very sustainable, because financial assets are supposedly to reflect the value of the real economy and the value of the company operating within the real economy. Now, any thought on further expanding fiscal expenditures or monetary easing and prolong this decoupling any further, or now it's more time to have rational sort of price discovery should be in the market?
You know,
Not a tricky question, but are you still bullish or time to be bearish.
Well, I'm definitely the wrong person to ask this question to, because I'm a very pessimistic person. So I can see more reasons for anything to go down than to go up on a personal basis. But the problem is, how do you think about it? By what measure do you say something is overvalued or not, especially in a zero interest rate world? Because everything is about relative value. So when there's zero interest rates, then suddenly, there's much more upside to equities. Look at a dividend yield compared to what you can earn on an investment grade corporate bond. So how do you even think about it? And if you assume that we will have zero interest rates for the next 2, 3, 4, 5 years, Goldman Sachs says till 2026. At the same time, they're saying huge reflation trade in the US. Then maybe equities aren't overvalued. I just think I've totally lost my bearings in this world, because, if it's all about relative value, and you earn nothing on a government bond, or in many countries, you're actually losing money, then who's to say whether equities are overvalued? We've lost our traditional relative value measurement tools. So it's very hard to say, and to me, that is a huge problem.
Okay. All right. Okay. The focal point here is that we need to watch the interest rate development. As long as we have a super low interest rate for the time being, the valuation of equities could be quite substantial, because obvious from the basic formula for equity valuation. So.
But I do think the only prediction I can make is that we will see volatility.
That's great.
But, which isn't very profound.
That reminds me of the legendary Burton Malkiel from Princeton, the great author of Random Walk.
Yes.
Yeah. Once he was asked by reporters that, how do you see the market going from now on? There were all the press people were looking for some clue for up or down. His response was, well, my response is that market will fluctuate. That's the best answer I could get. Anyway, okay. Now, for next 10 minutes, let's talk about ESG. Now, this environmental, social, and governance have become a buzzword, if you like, or the hot topic for not just for investment firms, but for the private enterprises and at government level or international level. Increasingly, more attention is being paid to this to secure more stable, sustainable growth environment for company and for country and for the world. Now, but this is not very new. As you know, it started, if you will look back, the term ESG started about almost 15 years or so, 2006 or so, by UNPRI, first used this term. But since then, it hasn't really attracted much attention. But apparently, this pandemic crisis has been has created a momentum for this to become a mainstream issue for corporate management, investment portfolio management, and also government policies. There, as I said before, BlackRock has been the key driver for this change, and Larry's commitment to this issue has made the situation quite different. Could you elaborate on what sort of what's really behind this, and what we should expect from this adoption of ESG concept from now on, and how strongly the world's largest investment firm, BlackRock, committed to this, so that this is not just a short-term sort of fashion, but very profound and lasting impact on government policies and corporate management.
You know, Larry really believes very deeply in this. And, you know, in some ways, BlackRock is very much Larry's firm. You know, I've watched Larry build it for decades, and it is amazing to me how he still runs it as if it's a very small company that reflects his beliefs that, you know, people should earn something on their savings and not be raped and pillaged by their asset managers. But on an objective level, he thinks to not think about ESG is a big risk. So in a way, it's all about risk management as an institutional firm who's a fiduciary for our clients' money. So it's a kind of risk management and a smart policy when you invest, but it's also a deeply personal commitment. And, you know, I think that COVID, as we said yesterday, as you pointed out yesterday, COVID has been a catalyst for much greater awareness. You know, and the public sector has a huge role, and the private sector has a huge role. And I think in many countries, you know, governments did not rise to the challenge of dealing with COVID when there's a clear template and a clear urgency on how to deal with it. And, you know, one of the things that I worry about is that, you know, politicians think in terms of election cycles, you know, 2 years, 4 years, you know, and so do governments have the right incentive structure? You know, politicians who are in power today, will they reap the rewards of taking a longer term view? Or will they think, well, I'll be out of office by the time these things kind of pay off? And, you know, more and more, you know, private sector thinks we have to step in. You know, so it's very ironic that, you know, and this also stems out of Larry's thing about sustainable capitalism, that capitalists and companies cannot just take a short-term view about maximizing shareholder benefit. And of course, this is 50 years since Milton Friedman of UChicago published his shareholders first and last kind of belief. And I think a lot of people are disillusioned with that. A lot of companies say, we have to be more responsible. We have to take a longer term view.
Right.
And we can't just depend on the public sector, you know? So, you know, I think there's a lot of concern about greenwashing, so-called, you know, espousing it, but not really following up on it. You know, what is the right time frame for transitions? You know, do initiatives should to what extent does a project make sense if it's not profitable as well? I mean, something like the IFC arm of the World Bank says, if it's long-term not profitable, does it really make sense? When you think about affordable housing, how do you balance the trade-offs? What should be the priorities? So we're all feeling our way, but that's fine, But, these are the questions we all have to be thinking about. What is the right pace of transition? How do, you cannot go overnight from a world based on, traditional prototypes. I was in New York just over a year ago, and the head of the Kuwait Investment Authority was giving a speech, and it was all about, so the Kuwait Investment Authority, it's 600 billion or whatever it has under management. That all comes from oil. How did these economies diversify and over what period of time, But I do think that the thing about COVID is it has also made the S, much more important. And the conference that you sponsored in November, I was so impressed by, how much thought KIC and NPS are giving to the S as well as the E. But rising sea levels threatens all of us. Climate change threatens all of us. I see it in Hong Kong. Last summer was the hottest summer in history, if you measure the number of very hot days. The second hottest summer in history was in 2016. We had 50% more very hot days in 2020 than we just did 4 years earlier. That's the speed of the acceleration. If I go to a city like Karachi in Pakistan, people tell me when I was a child, there were orchards outside the city. Today, it's desert. Wars will be fought over water in many places. I go trekking in the Himalayas, and I see these very, small scale hydro power, stations. There's no water to turn the turbines. We need to have a sense of urgency. And if you're a financial firm, it's so right to think of it as a form of risk management.
Right. Thank you very much. Very important takeaways from what you have said just before is that if I rephrase it, ESG, in my view, can be defined as the tool for long-term comprehensive risk management. Now, we have to emphasize this long-term because now one of the key changes that we are experiencing in the process of this pandemic crisis is that the paradigm shift. That is that from short-term thinking, short-term perspective to longer-term perspective is one thing. The other is from efficiency to resilience. Now, resilience requires very careful risk management paradigm in place. Now, I saw Larry's annual letter to CEOs last year's and this year's. The one thing that came out repeatedly, that is that climate risk is investment risk. That's a very important point that we often forget. So what you have described just before is that this issue of climate change and how best we deal with it is not the issue that can be dealt with later. It's just now we have to commit ourselves to making viable changes now, because as you said, Hong Kong's temperature change, and Seoul, Korea has been experiencing that very rapid rise in overall temperature as well. So that's these kind of things would be the important lesson from the pandemic-caused crisis we have had since last year. And if we get good lessons for the better future for our next generation, I think this is not, this good crisis should not be wasted, as Winston Churchill once said. Then I think we are making good out of this terrible pandemic crisis. Now, thank you very much, Henny, for 1 hour. I think it's like less than 10 minutes. We had so much things covered in such an efficient way and very touch way. I would like to thank you once again very much for joining us to share with your insight and perspectives on this number of issues relating to global economy, market, investment, and the future of our human being. Okay, thank you very much. Is there anything else you would like to add this time?
Hopefully next time we will meet up in the real world,
not virtually.
And then we will have a larger conversation and more inclusive conversation.
Okay. All
with
right.
everyone there. Thank you so much for having me.
Thank you, and I very much look forward to seeing you real, not just a virtual, with the help of vaccines, perhaps. Okay.
Thank you.
Take care of yourself. Okay. Bye now.
Happy New Year.
Okay. Same to you. No. Okay.
Bye.
Thank you.